Hey everyone, I'm Dan Saavedra from mergerdata.com, and today I wanted to talk about why you should expect a really large increase in your SaaS costs over the next few years. So, your software as a service subscriptions will probably be increasing in pricing significantly if you haven't already seen that over the last few years. I've recently come across a report by Vertus that basically breaks down some of the data that they're seeing from the past 5 years and my interpretation of it, why I think that this isn't going to stop. And I think that this first insight that I pulled out of the report is really critical to pay attention to. You can see that one in every $8 is spent on software as a service in an average organization. And that's a pretty big deal. That's a huge line item. And so if we're not paying attention to that spend and optimizing for it, it can really eat into our margins. So this is just a really critical thing to pay attention to, because this isn't just something that you should visit once every year, once every 2 years. It's taking a significant amount of resources, both in the subscription cost itself and the labor cost to set up those subscriptions and maintain those subscriptions. So this next slide is a pretty good summary of what I'm going to be diving into a little bit, which is basically the rate that software subscription prices are outpacing actual market inflation. So their real costs are going up significantly. The pink bars are the cost of SaaS if it was in line with inflation. So this is the market inflation. This is the cost of doing business and how much that's increased by, anchored compared to 2017. And then the blue bars there are the actual price increases from vendors, anchored in 2017 as well. And so you can see that the cost increases for software subscriptions has significantly outpaced the actual market inflation here. So now, since we set the stage with some of this data from this report, I'm going to dive into two specific things I think are impacting software prices and basically address what you can do to hedge for this risk and how you can make sure that you're minimizing that cost of software subscriptions for your business. So number one, a lot of these platforms have increased their capabilities since 2017 so that they're covering more bases. They're actually doing things that you would need multiple subscriptions for before. For example, you would need a Calendly to allow people to schedule meetings before, and then you would also need HubSpot for a CRM and for running your marketing. But now HubSpot has the calendar booking feature, so you don't really need the Calendly subscription unless you have a very, very, very specific use case. And so basically these platforms started out with a very niche problem that they solved and very niche capabilities, and they've slowly expanded their platforms so that it covers more capabilities and they can demand a higher licensing cost. And so they've introduced more tiers and they've introduced different types of licensing structures to give you access to specific feature sets that you normally would have to go out and subscribe to a new tool for. And so this is a justified reason to increase prices as a SaaS application, in my opinion. And one way that you can not be as impacted by these price increases is to do an audit of all the tools that you have and make sure that these increased capabilities and pricing from certain platforms aren't duplicate features from other subscriptions that you have. So if you do have that Calendly subscription and you also have a Marketing Hub Pro or Enterprise Sales Hub Pro or Enterprise subscription in HubSpot, then you should look at eliminating that Calendly subscription just because you have that feature set inside of HubSpot itself. Now, the second thing to dive into here is the reason why companies are increasing their prices when they might not be offering feature sets that are actually replacing other tools. And this is more of a macroeconomic reason. Many software companies were funded by venture capitalist firms. And because of that, they were able to get away with business economics that simply didn't make sense. Their revenue and their recurring revenue and their growth rate were not being supported by the valuations that they were receiving. And as funding has slowly dried up here in the past couple of years, you're seeing these businesses being forced to actually have good unit economics. And so being valued at several $billions when you're only doing tens of millions in recurring revenue is just not realistic anymore. You cannot run your business when you're not getting that next funding round. And so the answer to this is to increase your subscription cost to your existing customers or increase the number of customers that you've acquired, which is very difficult if you don't have the funding to do so and haven't found that formula to work in the past already. So when you're evaluating software vendors, it might not be a bad idea to take a look at their financial statements and make sure that their unit economics actually make sense. If you're looking at a company's financial statements and for whatever reason, their revenue and their growth rate doesn't support their valuation and their operating expenses, then it might be worth it to look at another vendor to make sure that you're going to be investing your own time and efforts into a platform that's actually going to remain stable and it's actually going to exist in the future. If they have to double their prices in order to support their operating expenses, then that cost is going to be passed on to existing customers. It's just too difficult to guess whether or not a company is going to be able to sustain its current pricing if funding dries up or macroeconomic conditions continue to worsen. And even if a company's financial statements aren't available, you can still poke around and ask whether or not there's some information that you could have around the company's operating expenses, revenue, number of customers, that type of things, just to make an educated guess. Now, obviously, in the private sector, it's going to be very difficult to get that information. But overall, it still doesn't hurt to ask and get an idea of whether or not a company is healthy for your own long-term investment. The worst thing that you can do is to invest hundreds of thousands of dollars if you're a large organization into a software tool, and then 5 years later, your prices double because that company now is feeling the squeeze. They couldn't raise that next round, and they have to make up that revenue somehow so that they can cover their operating expenses. So it's just something to consider when you're looking at new software subscriptions or when you're renegotiating. Number one, make sure that the increase in prices are justified by the features that are added and the tools that those features are going to actually replace. Number two, make sure that the company that you're investing in is actually financially sound. You are investing in this company. It's not like you're buying stock in it, but you're investing your own company's operations in this company because you're using their tool and depending on this tool for your own function. So these are two things that came across my mind when looking at the SaaS inflation index. I thought that the graph was really telling because software does feel like it's getting more expensive. It feels like the industry has really been operating off of poor unit economics for a long time, and now they're making up for that since funding has dried up. So be diligent when you're looking at the contracts for the software that you're subscribing to or that you're renewing. These are important points to look at. There's some red flags that can pop up when you're looking at these software companies, and this can prevent a lot of hurt for your organization. So I appreciate you watching. I'm Dan Saavedra, the founder of MergerData.com. We're always on the negotiation side of these types of contracts, so we've seen a lot of these red flags, and this is why I wanted to bring up these 2 points with this data from this great report by Virtus. So I appreciate you watching, and I'll see you next time.